on canes as we speak. But let's refocus and talk about some more earnings. On the flip side, Metropolis Healthcare, very good quarter coming in for them for quarter four, largely inline numbers with our estimates, and growth has been very good across the board for quarter four. So let's interact with the management in terms of what has worked out for them in quarter four, and more importantly, what's the outlook for FY27. We have Mr. C. Surendran, the MD at Metropolis Healthcare, joining us on the show. Mr. Surendran, thank you so much for your time. First, let's talk about how quarter four has been for you. Revenue has seen an uptick of 23%. Patient volumes have also grown 11%. Help us understand what specifically is driving this mix improvement and what's the outlook as we head into the upcoming quarters.
All right, good morning and good morning to all your viewers. We've had a very excellent quarter four, and a grand end to the year. We have had 23% revenue growth, and the margins, of course, on a very high side, 70% plus kind of margin growth we had in quarter four, and we ended the year very well. The things, there are two or three things which is really helping us to grow this, get this kind of a growth. One, of course, our continuous focus on the specialty segment and our focus on the true health. These two are segments which is growing faster than the company's growth. Now, this is definitely helping us to grow. And also the integration that we have done of all the acquired entities, 4 entities we have acquired during the last 12 months, and the acquisition is almost in the last phase. They all started performing well. That's helping us to grow. And in terms of the guidance for the coming years, we definitely see that a revenue growth of 14 to 15% CAGR is definitely possible in the next 2-3 years. That's what our estimate at this point of time, and our margins will also come closer to 27-28% in the next 2 to 3 years time.
All right. Hi, very good morning, Mr. Surendran. This is Shrishti also joining in. But just help us understand what's the sentiment on ground, or rather, what are you witnessing in terms of the discretionary testing? Are you seeing any signs of slowdown over there, or the demand is still resilient as we enter into quarter one FY27?
In fact, in the last 2 quarters, we have seen improved need for the high-end specialties testing. And also, like that we have launched the genomics testing in the last quarter. We have also seen very high uptake on the genomics testing. So all the specialty segments is really doing well. And also the preventive health is another segment which is really seeing good amount of traction. So I think the overall diagnostics is moving away from a concentration on the routine and semi-special testing to more of specialty and preventive healthcare kind of a testing. That's a real movement that's happening in the industry, and that's really what is driving us the growth. In the last quarter, we had about 10% of the patient volume growth which has come in. So some of this is really happening because of the specialty and the preventive healthcare kind of segments.
Okay. Mr. Surendran, you did share your guidance on the margin front for the next 2 to 3 years. You've given that range between 27 and 28%. This time last year, your margins were around 18%, if I'm not wrong. Yes, exactly at 18% for quarter 3 FY25. Talk to us about what has shaped up on the margin front in 1 year that we've seen such a big spike to 25.5% this time compared to 18% this time last year, and what gives you the confidence of reaching this 27 to 28% margin guidance that you've given over the next 2 to 3 years?
See, 3 big initiatives have happened, during this year. One, of course, at the end of last year, we mentioned that our massive lab expansion has come to an end. And now it's time for us to go and bring in productivity from the labs that we already set up. So our actions around improving the number of centers around each lab has really taken off very well. And we are seeing a very good throughput coming, and the productivity of each of the labs getting better. And with no more new labs getting added, there is no erosion in the margins. That's one big step that we have taken. Second one is we have really done relook at our lab tech platforms, the platforms in which the testing happens. We looked at upgrading this platform, some vendor consolidations that we have done. And we've also brought in the best of technology in the labs. That's really giving us improved material consumption. And also we have improved introduced some technology enablers in the labs to reduce our material consumption. So this definitely is helping us. And there are many other productivity enablers through the digital and the automation path that we are taking. So all these are giving us very sustainable, margin upside. You could see, like you rightly mentioned, we could see that all playing out this year. And I think the next 2 quarters our lab platform changes will complete. And that's where we are confident about further improving the margin from where we are leaving at the end of financial year 26.
All right, good to hear about that. But let's talk about your core diagnostic because the integration was expected in Q1 of FY27. What are the key milestones and integration risks that are still pending?
No, well, I think like I said, we are on the last phase of the integration. Technology part of the integration is almost over. People integration is over. All the synergies that we want to bring in are all over. Maybe the next 3 to 4 months time, we'll complete the full integration in terms of aligning the product portfolios, the sales strategy, etc. So I think more or less we are done with integration. I think next 2 months we'll give 2 to 3 months we will bring it to a closure, and then it will be business as usual for us.
Right. And also help us understand your acquired entities. The contribution has been 8% to the overall FY26 revenue. What is the expected timeline to scale this up? Any contribution that you are targeting from these entities? And more importantly, any more acquisitions on the cards?
So the year one, like we mentioned in the past, is all about cleaning up the business and bringing in tune with the Metropolis ways of working. So that part. So we did not concentrate too much on the volume growth or the revenue growth in the year one, but we concentrated on the synergies and the integration of the platforms, which we have completed. And this year will be an year where we will definitely take off with respect to the revenues and volume growth, etc. That will happen, and that will be in line with the rest of the organization's growth. So we clearly see that all the acquired entities will help us to further grow, as that's the reason we are resetting our guidance for the coming years, right? And in terms of the new acquisition, we are always in the hunt for suitable opportunities for us to come and buy out. So we are looking out for it. We have a pipe, and then once this integration of the already existing acquired integrities are over, we will have the time and energies to go and do the next set of integration of the newly acquired entities. So we are definitely working on it, and maybe we will see some progress as we go forward in this year.
All right, but Tier 1 contributes around 66% of your revenue and Tier 3 contributes 26%. What is your strategy in Tier 2 cities, currently only contributing 8% of the revenue? What sort of a target mix are you looking at?
Well, our tier 2 cities are, growing at the same time at around 20%. We have brought in some new labs in the past, and some of the acquired entities are sitting in the tier 2. So tier 2 will also definitely will grow us. And there are some cities that we identified we need to put some extra focus, which we will do it, right? So our plan will be all the three tiers, tier 1, tier 2, tier 3, all the three segments should grow in the days to come.
Mr. Surendran, I want to get some clarity on the revenue guidance that you've given over the next 2 years. 14 to 15% is the growth that you're targeting. I'm taking a look at your FY26 growth. You've grown at 24%. Any reason why you are moderating this guidance as we go ahead?
No, well, I mean, in the year 26, you got the additional revenue from the acquired entities, which you like you mentioned sometime back, it's about 8%. So 8% has come over the 13.5% that we did last year. 13.7% we did an organic level, and the remaining about 8 to 9% come because of the newly acquired entities. Now, for the coming year, the revenue of the acquired entity will be already there in the baseline. That's not going to come on top of it, right? That's the reason you will find that the revenue guidance for the coming year is in the range of 14-15%.
All right. So we look forward to that. With this, we let you go. Thank you so much for taking the time out and speaking with us.
Thank you. Thank you very much. My pleasure.
All right. So that was